The chaos has officially begun. The used car market, once red hot and untouchable, is now in full-blown collapse. And at the center of this meltdown is one name nobody expected to fall this fast. CarMax. Once hailed as the future of used car retailing, CarMax is suddenly drowning in unsold inventory, evaporating profits, and a storm of consumer panic that's rewriting the entire US auto market. This is the CarMax crisis no one saw coming, where $40,000 cars are now being sold for as little as $15,000, and the company that once defined the American used car dream is fighting to stay alive. Let's start with what's happening right now. Across the country, CarMax lots are overflowing. Rows of cars sit motionless under the sun. Teslas, BMWs, even family SUVs that just a year ago sold within days are now gathering dust. Employees describe parking lot gridlock, with some locations literally running out of space to park newly acquired vehicles. The company's storage lots, which used to turn over inventory in weeks, are now holding vehicles for months. Every passing day, those cars lose value, and that's when the price collapse began. In late 2024, CarMax quietly started slashing prices across its network. It wasn't a few $100s here and there. We're talking about vehicles dropping $10,000 to $20,000 overnight. A 2021 Toyota Highlander that was listed for $38,000. Now it's being advertised for $21,000. A used Ford F-150 that sold for $42,000 last year. Try finding one now for $1,800 to $900. And perhaps the most shocking, electric vehicles like the Tesla Model 3 and Chevy Bolt, once prized for their resale value, are crashing hardest of all. The reason? CarMax's hidden inventory problem. During the pandemic and post-COVID boom, when used car prices skyrocketed, CarMax went all in. They bought aggressively, paying premiums for vehicles they thought would only go higher in value. But instead of doubling profits, that gamble backfired. As interest rates soared and new car prices dropped, used cars suddenly became overpriced relics of a past market. Consumers walked away. CarMax was left holding the bag. Thousands of high-end vehicles financed at inflated values, now depreciating faster than ever before. Their warehouses became black holes of debt. Insiders report that some locations were forced to pause purchases entirely, trying desperately to unload what they already had. And then came the real detonator: interest rates and the auto loan time bomb. For years, Americans bought cars on cheap credit. 2%, 3%, even 0% financing deals were common. But now, average auto loan rates have exploded past 8% or even 10%. Monthly payments that used to be $400 are now $700 or $800, even for used cars. That means fewer buyers can qualify for financing, and more existing owners are defaulting on loans they can no longer afford. Those defaults flood the market with repossessed vehicles, and guess who's buying many of them back at auction? CarMax. The same company already drowning in inventory is now competing with banks and lenders trying to dump repossessed cars, creating an avalanche of supply and collapsing prices even faster. And while consumers are starting to see what look like amazing deals, the truth is darker. CarMax is losing money on a massive scale. Each car sold at a 20% or 30% discount cuts directly into profit margins that were already razor thin. Insiders claim CarMax's margins have dropped below 2%, forcing the company to quietly lay off workers, reduce acquisition spending, and cancel expansion plans. But here's where things get even more dangerous: CarMax's failed bet on EVs and luxury cars. During the height of the hype, CarMax stocked up on Teslas, Lucids, and high-end SUVs, expecting that demand for electric and premium models would keep rising. Instead, EV demand stalled, charging infrastructure hit limits, and luxury buyers pivoted back to new vehicles after automakers slashed prices. Those $60,000 Teslas that CarMax bought at a premium, they're now worth half that, sitting on lots with nobody willing to pay even close to what the company invested. This was supposed to be CarMax's winning play: diversification into the high-end market. Instead, it's become the anchor pulling the company underwater, and the shockwaves are spreading far beyond CarMax. AutoNation, Carvana, and other used car giants are now facing the same nightmare: inventory piling up, prices crashing, and loans defaulting at record record rates. The so-called 2025 used car recession has officially begun, and it's hitting every corner of the industry. Dealers are slashing prices, manufacturers are offering desperate incentives, and Wall Street investors are beginning to panic. But this isn't just a business story, it's an economic warning sign. Americans are tightening their wallets. Inflation, layoffs, and shrinking paychecks mean people simply aren't buying cars. Consumer confidence has fallen off a cliff. The same customers who once lined up for overpriced SUVs are now waiting for prices to fall further, or avoiding the market altogether. And that hesitation, it's turning into a vicious cycle that drags prices down even more. Meanwhile, internal leaks from CarMax suggest that the company has been quietly restructuring operations to survive. Hiring freezes, cuts in advertising budgets, reduced purchase offers for trade-ins, and even more shockingly, some CarMax employees say management is preparing for a major restructuring that could see dozens of locations downsized or consolidated in 2025. And Wall Street didn't see it coming. CarMax's stock has been quietly bleeding for months, with billions in market cap erased almost overnight. Investors who once viewed the company as recession-proof are now realizing just how fragile the used car business really is when credit dries up and consumer demand disappears. But the real question now is, can CarMax survive this storm? Because if it can't, the fallout could reshape the entire US auto industry, from financing companies to automakers themselves. If CarMax goes down, the domino effect could be catastrophic. Think about it. CarMax isn't just a used car dealer, it's a massive ecosystem. It buys cars from consumers, sells to retail buyers, moves vehicles through auctions, and finances a large share of those purchases through partner lenders. A collapse at this level would send shockwaves through every layer of the auto market. First, the banks. If CarMax starts defaulting on its massive credit lines or floor plan loans, financial institutions that back their inventory could take heavy losses. That means tighter lending rules, higher rates, and fewer approvals for regular buyers. Lenders like Ally, Capital One Auto Finance, and even regional credit unions would be forced to pull back, choking off the last bit of oxygen from an already fragile market. Next comes the consumer fallout. When people see used car prices collapsing this fast, $40,000 trucks now worth $15,000, they stop buying altogether. Nobody wants to catch a falling knife. That means dealers can't move cars, automakers can't sell new ones, and the market grinds to a halt. It's eerily similar to what happened during the 2008 housing crash. When buyers realized that waiting meant saving tens of thousands of dollars, demand simply vanished. And just like housing, many of these cars are underwater. Millions of Americans who bought vehicles at inflated pandemic prices are now discovering that their cars are worth far less than what they owe on their loans. Some are stuck paying $700 a month for a vehicle that's worth half its loan balance. The result? Defaults, repossessions, and another wave of cheap cars hitting the used market, pushing prices even lower. It's a downward spiral with no clear bottom. Meanwhile, dealerships are scrambling to hide their losses. According to industry insiders, some lots are now reclassifying vehicles, marking them as certified pre-owned or limited edition models to justify higher prices. Others are quietly adjusting odometers and condition ratings in listings to make the same cars look newer than they are. It's a desperate attempt to maintain the illusion of stability in a market that's collapsing by the day. But consumers are catching on. Online platforms like AutoTrader, Cars.com, and Edmunds are flooded with price drops. In some cases, listings are being cut 3 or 4 times a week just to get views. And CarMax's once polished reputation for transparent, no-haggle pricing is taking a hit. Customers now know that no-haggle price might not be the best deal anymore. Then comes the bigger question. Now, is this the end of the $30,000 used car? For decades, used cars held strong value, often selling for 60% to 70% of their original price. But now, with oversupply, loan defaults, and panic-driven markdowns, that standard is gone. The $30,000 benchmark, once the middle ground for solid, reliable used cars, is vanishing. In its place, a new reality where $15,000 to $20,000 cars dominate the market again, and anything over $25,000 sits unsold for months. This price reset could permanently reshape how Americans view car ownership. Leasing could surge, subscription-style models might return, and outright ownership may decline as buyers fear future collapses. And here's where things get even more intense. Automakers themselves are panicking. Ford, Toyota, GM, all are now slashing new car prices and offering record incentives just to keep sales moving. The logic is simple. If used cars are this this cheap, nobody's going to buy new ones at full price. Ford has already cut prices on the F-150 Lightning. GM is offering unheard of financing deals on SUVs. Toyota is discounting hybrids and cutting delivery fees. A rare move for a company known for holding firm on prices. In other words, CarMax's crisis is now becoming Detroit's problem, and behind closed doors, analysts are whispering about the unthinkable. Could this trigger the first auto market depression in modern US history? Think about it. You've got collapsing prices, soaring loan defaults, mass repossessions, shrinking consumer confidence, and now manufacturers being forced into a price war they can't afford to lose. The auto market, at new and used, is now locked in a dangerous feedback loop that threatens to drag the entire industry down. And as all this unfolds, a quiet technological revolution is waiting to take advantage. AI-driven online auctions, automated valuation tools, and digital-only marketplaces are rising fast. Platforms like ACV Auctions and Copart are now using AI to price and move vehicles faster than traditional dealers ever could. That means the future of used car sales might not even involve physical dealerships at all, a future where CarMax's brick-and-mortar empire could become a relic of the past. But before we talk about how AI and digital disruption could finish what this financial collapse started, we need to look at what's really happening inside CarMax right now. Because according to multiple insider reports, the company's next move could determine whether it survives or disappears from America's roads entirely. Inside CarMax's walls, the atmosphere has shifted from confidence to quiet panic. Employees describe it as walking on eggshells. Meetings that used to focus on expansion and innovation are now about damage control, cutting losses, freezing hiring, and trying to stop the financial bleeding before it's too late. Whispers from regional managers suggest that CarMax is sitting on more than 60,000 unsold vehicles nationwide, each one depreciating every single day. That's billions of dollars in inventory value disappearing month by month. And when you add storage, transportation, and interest costs, the math turns brutal. Every unsold car becomes a ticking time bomb on the balance sheet. Executives are now scrambling to offload vehicles fast. CarMax has begun quietly testing bulk liquidation programs, selling groups of cars to smaller dealerships, rental companies, and fleet buyers at massive discounts. In some cases, these cars are being sold below acquisition costs just to clear space and free up cash flow. That's not a strategy, that's a survival move, and the fallout doesn't stop there. Reports from insiders reveal that CarMax has begun trimming its workforce behind the scenes. While public announcements have been vague, several departments, including finance, marketing, and logistics, have already seen quiet layoffs. The company isn't calling it downsizing. Instead, it's using phrases like operational optimization and market adjustment. But employees know what's really happening. The company that once prided itself on being recession-proof is now preparing for the hardest year in its history. Meanwhile, analysts on Wall Street are desperately trying to make sense of the numbers. CarMax's profits have plunged nearly 50% year over year, according to recent filings. Their stock has tumbled as investors realize that the used car gold rush is over, and what's left is a mountain of overvalued assets and vanishing demand. But what caught investors completely off guard was how fast the collapse happened. In less than 6 months, used car values across the US dropped by double digits. That's something even the most bearish analysts didn't predict. It's not a gradual decline. It's a freefall, and CarMax, with its huge inventory and reliance on high resale values, is taking the full hit. To make matters worse, the company's once brilliant digital sales model, the same system that helped it dominate during the pandemic, is now working against it. Because customers can instantly compare prices across dozens of states, every CarMax price drop ripples through the market instantly. The moment CarMax cuts prices, competitors are forced to follow, amplifying the crash even further. It's a race to the bottom that no one can win. And while this price war plays out, something even more alarming is brewing beneath the surface. Loan defaults are exploding. Consumers who bought during the 2021-2023 price surge are falling behind on payments. Subprime auto loan delinquency rates are now at their highest level since 2009. That means banks are repossessing cars at record pace, and those cars are ending up right back in the used market. Every repossession adds another vehicle to the pile. Every new listing drives prices lower, and every price drop erases more equity from the next wave of buyers. It's the same domino pattern that triggered the housing collapse 17 years ago. Only now, it's happening on America's driveways instead of its suburbs. And here's where things start to get terrifying for the broader economy. Auto sales aren't just about cars. They drive everything: lending, insurance, manufacturing, and even in local tax revenue. A full-scale crash in used car values could send billions in losses rippling through banks, credit unions, and city budgets. Counties depend on vehicle sales taxes and registration fees. Lenders rely on car loans for steady profits. And when those systems start breaking down, it doesn't stop at dealerships. It spreads into the economy itself. That's why some analysts are already calling this moment the beginning of the used car recession of 2025. And CarMax, the company once celebrated as the safest bet in American auto retail, has become the warning signal for what's coming next. But what's truly shocking is what insiders say CarMax plans to do next. A strategy so desperate, so unprecedented, that it could either save the company or destroy it completely. According to multiple insider reports and leaked investor briefings, CarMax is now preparing for what some executives internally called the Great Reset. It's a radical restructuring plan designed to completely reinvent how the company operates, but it's also a last-ditch attempt to survive a collapse that's already in motion. Step 1 of that plan? Dump the dead weight. CarMax is reportedly planning to liquidate tens of thousands of vehicles at auction-level prices, bypassing retail altogether. That means cars that were once displayed proudly on CarMax lots could soon be sold in bulk to wholesalers, rental companies, and even online auction houses for pennies on the dollar. It's a fire sale, and it could flood the market with cheap inventory, crushing smaller dealerships who can't compete with the price drops. Step 2, a digital pivot. CarMax wants to move away from its expensive physical stores and focus almost entirely on online sales. The company is testing AI-powered valuation tools, dynamic pricing algorithms, and virtual appraisals to sell cars faster, without the overhead of maintaining massive lots. They're even exploring partnerships with delivery companies to create CarMax Direct, a model where buyers never step foot on a lot. It's bold, it's futuristic, but it's also risky, because while technology might make transactions faster, it can't fix the real problem: collapsing demand and eroding trust. Consumers have lost faith in the used car system after years of inflated prices, fake deals, and loan traps. The convenience of buying online won't matter if people believe prices will drop another $5,000 next month. Step 3, a return to cheap cars. CarMax executives reportedly want to shift away from luxury and EVs, focusing instead on affordable sub-$20,000 vehicles, the segment that's suddenly booming as Americans downsize. The company's internal data shows that cars priced between $12,000 and $18,000 are selling nearly 3 times faster than higher-end models. That's a stunning reversal from just 2 years ago, when CarMax bet heavily on premium EVs and luxury SUVs. But the damage from those earlier bets is already done. CarMax still holds thousands of depreciating EVs, Teslas, Rivians, and luxury plug-in hybrids that are nearly impossible to move at a profit. And as battery technology evolves and repair costs skyrocket, consumers are getting more cautious about buying used electric cars. That's left CarMax sitting on a mountain of expensive aging EVs that no one wants. Now here's where things get even more intense, because CarMax's next move could reshape the entire industry. If CarMax succeeds in resetting the market with cheaper prices and faster online sales, it could force every other used car dealer in America to follow suit. That would mean massive price corrections nationwide, pushing used car values back to pre-pandemic levels, or even lower. But if CarMax fails, the opposite could happen. A CarMax collapse would send shockwaves through the entire automotive ecosystem. Lenders, insurers, and even automakers would face immediate fallout. Banks holding billions in auto loan debt would have to mark down their portfolios. Dealers who rely on CarMax auction prices as a market benchmark would lose their pricing guide, and investors would begin fleeing from anything connected to the used car sector. That's why industry experts are calling this a make-or-break moment for the US auto market. Because what's happening with CarMax isn't just about one company's bad luck. It's about the bursting of a bubble that's been building for years. A bubble inflated by cheap credit, pandemic shortages, and overconfident dealers who believed prices could only go up. Now, with interest rates soaring and consumer debt at record highs, that illusion is gone. The great unwinding has begun, and for millions of Americans, that means the next few months could bring both opportunity and danger. Because while used car prices are crashing to levels we haven't seen in a decade, the financial instability behind it could make buying, or financing, a car riskier than ever before. So what should consumers do now? Should you buy while prices plummet, or wait for the full crash to hit? And how far could this collapse really go before the government or Wall Street steps in to stop it? The answers might surprise you, because according to new data, this isn't the bottom yet. In fact, the worst may still be ahead. According to fresh market data from industry trackers like Cox Automotive and Black Book, used car prices are still falling, and fast. Analysts are warning that we could see another 15 to 25% decline before the market stabilizes. And if repossessions continue at their current rate, that crash could accelerate even more heading into 2026. For everyday consumers, that means one thing: timing is everything. If you've been waiting to buy, this might feel like the golden moment, but beware. Many experts say the market hasn't reached true bottom yet. Dealerships are still holding overpriced inventory purchased during the pandemic, and they'll be forced to slash those prices even further as the year goes on. Waiting just a few more months could save buyers thousands. But there's also a dark side. As financing gets tighter and interest rates remain high, those cheap cars could become harder to buy, even if their sticker price drops. Lenders are tightening credit standards, repossession numbers are climbing, and banks are starting to view used cars as high-risk assets. So while prices fall, access to financing is shrinking. And that's the dangerous paradox of this entire collapse. Cars are cheaper than ever, but fewer people can afford to buy them. Meanwhile, the ripple effects are spreading across the entire industry. Smaller dealerships that can't compete with CarMax's price cuts are closing. Auctions are flooded with repossessed vehicles. Automakers are cutting back production of new cars as inventory piles up. And consumer sentiment around car ownership itself is starting to change.